It's September 2008, and the Federal Reserve has just cut interest rates to practically zero. But there's a fundamental problem. Nobody's spending money, nobody's investing, and rates can't go any lower. The traditional playbook has failed completely. So the Fed makes an unprecedented decision. It's going to buy assets. Lots of them, on a scale no central bank has ever attempted before. This moment marked the birth of quantitative easing as a mainstream policy tool. But the story actually starts earlier. In 1995, an economist named Richard Werner gave this unconventional practice a name: quantitative easing. It was theoretical then, just a concept on paper. But 3 years later, Japan would prove it wasn't just theory. Japan's economy had stalled in the late 1990s. Interest rates had already fallen to zero, and traditional monetary policy had stopped working entirely. Desperate for a solution, Japan's central bank did something radical. It started buying financial assets directly, injecting money straight into the economy. These weren't small purchases made cautiously at the margins. The Bank of Japan committed to large-scale, sustained buying programs over extended periods, targeting both government bonds and other financial assets. The world barely noticed. Most economists dismissed it as a Japanese peculiarity, a sign of economic weakness rather than innovation. But Japan had just invented the emergency playbook that the rest of the world would eventually need. It would take another major economic catastrophe for the world to understand what Japan had discovered. Fast forward to 2008. The global financial system was collapsing. Lehman Brothers had just failed. Credit markets had frozen. Normal interest rate cuts weren't stopping the panic because investors had stopped responding to rate changes altogether. Why bother chasing returns when the world seemed to be ending? At a certain point, cutting rates from 5% to 3% to 1% doesn't matter anymore. People hoard cash instead. This creates a dangerous condition called a liquidity trap. In a liquidity trap, consumers and businesses stop spending and investing no matter what interest rates are, because confidence has evaporated and fear dominates decision-making. A central bank's conventional tools, lowering interest rates, become essentially useless. You can push rates to zero, but if nobody wants to borrow or spend, the money never circulates through the economy. The economy stalls despite the central bank's efforts. This is the wall that conventional monetary policy hits, and it's terrifying to a central bank that has no other options. The Federal Reserve faced a choice: give up or try something untested. They chose the latter. The Fed started buying government bonds, corporate bonds, and mortgage-backed securities in enormous quantities. The purchases weren't small or cautious. They were massive, predetermined, and sustained over months. The goal wasn't subtle interest rate adjustments. The goal was to force money into the economy by making safe assets disappear. It was a deliberate strategy. Remove the safest, most liquid assets from the financial system and force investors to take risks they wouldn't normally take. Here's how it actually works. When a central bank buys a government bond from a bank, the bank no longer has that bond. The central bank now owns it. This removes the bond from the financial system entirely. With fewer safe assets available, investors can't buy what they want anymore. They're forced to move their money somewhere else. They buy corporate bonds instead, or stocks, or real estate, or anything riskier. This push toward riskier investments is intentional. It's the entire point of the operation. By making safe assets scarce and unattractive, the central bank herds capital into riskier parts of the economy where it might actually get spent or invested. Theoretically, more spending means more economic activity. More economic activity means more jobs, more growth, more inflation, pulling the economy out of its trap. The Fed's purchases also expand the money supply directly. When the central bank buys a bond and credits the seller's account, new money enters the economy. It's not money created through loans or traditional spending. It's money created by central bank decree, backed by newly purchased assets on the Fed's balance sheet. This money didn't exist before. The central bank literally created it to acquire these assets, adding liquidity where where conventional policy couldn't. This is radically different from conventional monetary policy. Normally, central banks only buy short-term government bonds. They make small adjustments. They signal future policy through careful language. QE throws subtlety out the window. It's large-scale, it's unconventional, and it targets longer-term and riskier assets. It's what happens when conventional tools have already failed, and a central bank has nowhere left to go. It's a statement that the situation is serious enough to justify extraordinary measures. The Fed deployed QE aggressively after 2008, buying trillions in assets. It worked well enough that most economists credit it with preventing a second Great Depression. But people often misunderstand what QE actually did. Many assume that a central bank buying bonds makes borrowing cheaper. But that's backwards. When the Fed buys a bond, it removes that bond from the market, making it harder to find one to buy. The real mechanism is forcing investors into riskier assets and expanding the money supply to restore confidence in spending. It's not about interest rates. It's about changing the entire landscape of available assets. 12 years later, the world would see QE deployed again. In 2020, a pandemic shut down the global economy overnight. Businesses closed, jobs vanished, and fear returned. The Fed didn't hesitate this time. Interest rates went to zero almost immediately, and QE started immediately after. The Fed bought bonds at scale that made 2008 look cautious. Trillions of dollars in purchases in just weeks. The playbook that Japan invented in 1999 and America deployed in 2008 had become routine. QE was no longer an emergency measure reserved for unprecedented crises. It was now the standard response to any major economic shock. It had moved from theory to radical experiment to established policy tool in just 2 decades. But here's what matters. QE reveals something fundamental about how central banks actually work. They don't just adjust rates and hope for the best. When the world breaks and conventional tools fail, they have one more option left. They can directly intervene in financial markets on massive scales. They can buy assets. They can create money. They can force the economy to move. It's not subtle. It's not elegant, but it's powerful. And once this power is unleashed, it becomes part of the central bank's permanent toolkit. So return to September 2008, when the Federal Reserve faced that zero-rate wall and realized traditional policy had run out of ammunition. They had one choice left: buy billions in financial assets and reshape the economy from the inside. That decision launched quantitative easing from theory into practice. It proved that when rates hit zero and the liquidity trap closes in, a central bank can still act. It can still intervene. It can still force change. And that power, the ability to create money and buy assets at scale when everything else fails, has fundamentally changed how central banks respond to crisis ever since. What started as a Japanese experiment became an American emergency measure, and is now a permanent feature of how the world's central banks manage economic catastrophe.